Good day, guys. My name is Iviwa, and on today's tutorial, we're going to be talking about lots. So, what is a lot, or what are lots? A lot is a measure of volume of a transaction in the forex market. So, in other words, if you want to buy, let's say you want to buy Euro USD, the number of volume or the number of units that you'll be purchasing will be measured in lots. So one lot is equals to 100,000 units of base currency. 0.1 lot is equal to 10,000 units of base currency. 0.01 lots is equals to 1,000 units of base currency. So 0.1 one lot is actually called a standard lot, and 0.1 lot is called a mini lot, and 0.01 lot is called a micro lot. So for example, if you're creating an account with a broker, and you'll find a place where they ask you they're going to ask you about leverage. So they're going to ask you if you want a standard, a mini, or micro account. So that's where they actually asking you how much lots do you want the broker to give you. On a standard lot, it means one lot and above. So it means if you open a standard account, you can be able to get 1,000 lot. One lot, meaning that you can order 1,000 units of base currency and above. A mini or micro account means you can order 0.1 lots or 10,000 units, um, 10,000 units or 1,000 units and above. You understand? Those are just the limits that they set for you. So whichever account type you wish to trade with, it's going to be based on lots. So let's talk more about lots. Let me make an example. Let's say you purchased the Euro USD at one lot. That would mean you purchased 100,000 units of base currency. So that's about 100,000 euros. You understand? So the ask price here is 1.2322. So if the broker's ask price is 1.322, 1.23228, and you want to buy this currency at one lot or 100,000 units of base currency, this means you have to multiply this by 1,000 so that you get your one lot. So to buy this currency now, you'll have to pay 123,000, just over 123,000. So not everyone is able to afford this amount of money. In fact, most people that are starting out in forex aren't actually prepared to pay this amount of money. So this is where leverage comes into play. So now that you understand what a lot is, I'll be moving on to explaining what leverage is. So let's talk about leverage now. So leverage is basically the amount of money that you receive from the broker to supplement your account. So as we've discussed in the previous example, one lot will mean that you have to pay 123,228 dollars to be able to afford to buy the Euro USD. Now 0.1 lot means that you have to pay just over 12,000, and 0.01 lots means you have to pay 1,223. Obviously we don't have this amount of money, or maybe we do not want to trade with this amount of money. So this is where leverage kicks in. So what the broker does, if you're looking at the scale here, the money that's on the left is the amount of money that you will be paying, and the money that is on the, the money on the right, sorry, is the amount that you will be paying, and the money on the left is the amount that is going to be paid by the broker. So basically what happens here with leverage is that the broker only gives you 99% of the money that is needed to trade. Let's make an example here. Let's say you have 500 dollars in your account, and you want to trade one lot on a trade, and the lots are equal to $12,000 or $12,322. So what happens here, if you have a leverage of 1:200, the broker actually borrows you 99% of the amount that is needed to trade. So you eventually end up having to pay only 1%. So that would be $123. So you'll be actually you'll be investing $123 into the trade that's worth $12,000 or over $12,000. So the broker is actually there to help you, as we said on the previous chapters about brokers, that the brokers are here to help you tap into the FX market. So this is one of the ways that they help you conduct transactions that you might not be able to afford, basically. So they actually borrow you money. In most cases you don't really have to pay this money, because you don't get to spend this amount of money. What happens is, with leverage, is the brokers, they lend you this amount of money so you can be able to be accepted into the market. Then they restrict this amount, so that when you trade and your trade starts to lose, this amount is not affected, and then you are stopped out of the trade with the amount that you initially invested. So the only thing they allow you is the opportunity to trade in the market. But we'll talk more about why these brokers do this, or how these brokers are able to afford to pay 99% for you so that you can start to trade. We'll talk about this on the next chapter on equity and margin. That's it for today's tutorial. I hope you understand what a lot is, and I hope you understand what is meant by the term leverage. We'll talk about equity and margin on the upcoming course. Yeah. On our previous tutorial, we explored the concept of taking a hypothetical trade with 0.1 lots, which was at a value of $12,322 dollars. Now, of course, this was way above our account balance, which was $500 at the time. If you're looking at the top right hand corner of your screen here, you will see the balance that we have on our account. So obviously we could not go in on the trade at the time. So we explored the possibility of leverage. So we went in and took out 1:100 leverage with the broker. So what this meant is that the broker could now borrow us 99% of the amount. So the broker gave us 99%, and we only had to pay out 1% of our money in order to be able to go into the trade. So our margin was $123. So we call this amount our margin. So let's discuss margin, the concept of margin, and equity, and the dynamics that go behind leverage, how it works, and how it helps us trade the market. Yeah, here's an example. We have $500 on our account. So what we do, we placed the 1% which was required. Then the broker placed the 99% leverage, as you can see here, in the green block. This is the amount that is being paid in by the broker, and if you see the red block, this is our margin. This is the initial amount that we actually need to pay in order to receive that leverage. And if you're looking at the blue box now, because we took out $123 from our balance of $500, we're now left with $377. We actually call this remaining amount our free margin. So this is the money that's going to be actually actively trading. You understand? So this is the amount that's going to be running the trade, and this is the amount that's going to be insulating the trade. So now these two, our free margin and our margin, we call them equity. So now our equity equals to free margin plus our margin. So let's talk about this margin here. What's this margin? This margin actually acts as an insulation or a protective layer between the leverage of the broker and our free margin, the amount of money that's running the trade. Now remember that the broker is giving us this amount so that we can be able to tap to be accepted or to tap into the forex market. So this money is actually increasing our initial investment so that it enters us into the forex market. We're not going to be trading with this leverage. This is just it's like a key, basically a key to open the doors, to open the trading doors for us. So this margin here is our protective layer, and this is our free margin. So as I've said before, this free margin is the amount that's going to be actively trading. So what's going to happen is, if our account suffers a loss of $100, it's going to be eating into our free margin. So the more our account suffers losses, the more our free margin depletes. It's going to deplete until it hits our margin, and then we will be stopped out of the trade, meaning that we will be stopped out before the trade hits into our free margin and then goes into the leverage. So as soon as it hits our free margin mark, the broker can now exit the trade, meaning that we've lost money and now we'll only be left with this amount. You understand? This is the only amount that's going to be left in the account, and the broker can now exit this trade. So they will exit with their money, because it was protected by the margin. You understand? If there was no margin, the loss will go down until it eats into the leverage that was provided by the broker. So this would basically mean you will have now to pay the broker back their money. But because there's margin, this leverage is actually protected from these unexpected losses. Now let's look at a case where your trade is actually profitable. Now in this case, let's say now our free margin is the same and we're actually making money. So we have our take profit set at a certain level, and our trade actually hits our take profit margin. So what happens here is that our free margin will increase. You understand? So the profits that we'll be making will be added onto our free margin. Then the broker will exit. The broker will exit with the 99%, and then we'll only be left with our what? Will only be left with our equity, meaning that we'll be left with our margin plus our free margin. That will add up to a total of $773. So this is the concept based on leverage, and this is how our margin protects the leverage, the broker's leverage, and this is basically what equity and margin is. Now with these kinds of possibilities, we can do more with leverage, and we can actually make substantial amounts of profits, This is actually opening doors for us as retail traders to be able to participate in this market, which is dominated by smart money or by the institutions that afford huge amounts of money to trade. So now we can actually be able to trade with these people because of the concepts that are introduced by the brokers. Yeah, that's it for today's lessons. Good day, guys. Welcome to yet another course on Forex trading. My name is Iviwa, and today we'll be talking about take profit and also talking about stop losses. Yeah, let's move into it. Basically, take profit is a point in the chart where you set or it's a point where you decide you want to exit with profits. You understand? So if you're anticipating that the market will move in a certain direction and you'll make profits up until a certain point, that certain point is a point which you set your take profit at, meaning that you want to exit at this point. You want to keep your profits. You don't care whether the markets move in a different direction or they continue up, but this is a point where you want to exit. So let's make a graphical example of this. Let's say this is a easier trade, right? And you decide to make a buy trade because you're anticipating that the price is going to move in an upwards direction. So you're like, okay, this price is going to move up, and maybe it's going to turn at this area, or maybe this is the area where you want to exit. So you're like, if it reaches this area, I want to exit, and I want to keep whatever money that I would have made from this trade. So that's where you would set your take profit. So what would happen is the price or the price action would move in your direction. It will move and it will hit your take profit. So this is where you'll be automatically exited with your profits, and you would get to keep the profits. Let's make another example of an opposite trade. Let's say now you want to conduct a sell trade, and you're like, yeah, the market is going to move down in a downwards direction. So you're like, okay, yeah, let me take a sell here and let me set my profits to at an area where I feel like price is going to reach. So the price moves, excuse me, and it moves and it hits your take profit. Now when it hits your take profit, this is a take profit being triggered. If you see the X here at the bottom, yeah, this is the area where your take profit will be triggered, and this is the profit where you will be exited from the trade, and you will get to keep whatever amounts you would have had or would have made in this trade. So this is a concept of take profit. Prices does not always move in the direction that you anticipate. That's why you always set these target areas so that you can be exited when price hits those areas. You can always, so it basically regulates your trades. It makes you it keeps you less busy. So now you're not always constantly looking at your chart, looking to find exits. So now your emotions will now be involved if you keep looking. This concept basically helps you eliminate emotion in trading. Yeah, let's talk about stop loss. Stop loss is basically the opposite of take profit. So you would set your stop loss at an area where you would be comfortable losing money. So you're like, nah, this is the area. If I lose a trade, I want to be exited at this area. So I want to lose a certain amount of money. Whereas in a take profit, you want to be exited at the place of profit. With a stop loss, you want to be exited in a place of losses. So let's look at an example this time. Let's say you conduct a buy trade. You conduct a buy trade because you anticipate that the price will be moving in an upward direction. But you always have that doubt in your mind that if price doesn't move in my direction, so I must set a stop loss. So if it doesn't move in my direction, and it moves to an opposite direction instead, this is where I want to be exited on the trade. So you do that, you set your stop loss, and your trade moves in the opposite direction, and you trigger your stop loss. and this is where you actually exit with a negative balance. So this is where you lose money. So you will lose whatever amount that your stop loss was set to. So now you are probably asking yourself like, why would I want to set a stop loss when it's going to lose me money? Basically, it's got to do with the risk reward ratio, the amount of money you're willing to risk on the market. Because you're setting your stop loss to protect. Now, let's say you didn't set a stop loss in this case, and the price kept continuing down. Guess what? This is where you lose your money. That's another area where you will lose your money. So let's look at another example where you had to conduct a sell trade. Now you're conducting a sell trade with an anticipation that the price is going to move to a downward direction. But it's not always the case with Forex. Maybe your analysis were wrong, or whatever reason, the price decides to move in a different direction, and you set your take profit to a different to a certain area. So the price moves and it hits your take profit. This is obviously where you'll be exited at a loss. So now what would happen is, if you didn't set your take profit, guess what would have happened? The price would have continued to the opposite direction and you would have lost more money. So the concept of stop loss is will actually prevent you from losing more money than you actually have to lose in the forex market. Now it's always wise to set your stop loss and your take profit at the same time. This actually, as I've said before, it actually helps you eliminate the risk of having your emotions involved in a trade. It eliminates you having to go into your charts every time you've placed the trade and always looking at the chart, and always having looking at the chart, constantly looking at the chart, actually puts your emotions at risk. This is where you'll find yourself that you exiting trades before they hit your take profit. You're always worried that you exit because you're worried that it's going to hit the stop loss, when it was not actually going to hit the stop loss. It was just going to turn next to the stop loss and end up winning the trade. So when trading, you just eliminate your emotions and just put your faith in your strategy and be like, this strategy is going to win. If it doesn't win, it's going to be profitable over a long time. So you place your trade and you let it run on its own. Do not check up on it. You don't do anything on it. You just let it run. If it wins, it wins. If it loses, it loses. But make sure that your strategy is profitable over a long run. But we'll be talking about those strategies later in the course. So yeah, I hope this course was informative for you guys. If you liked, hello guys, my name is Iviwe and welcome to yet another course on forex trading. On today's tutorial, we are going to be talking about the different types of orders in the forex market. So in the forex market, we have two different types of orders. We have the market orders, or the instant executions as some might call them, and we have penning orders. Now with penning orders, you have two different types of penning orders. You have the stop orders and you have the limit orders. Let's talk about market orders. So on our previous tutorial, when we started this course, we talked about the bulls and the bears, the buyers and the sellers. So in this case, we have the buy order, which is the instant execution. So if you're looking at the chart and you're seeing an opportunity, an instant buy opportunity, where you think you need to execute an instant buy order, or let's say you're looking at a market and you're thinking it's going to go in a different direction, or in a certain direction, or basically in an upward direction in this case. So in that case, you just execute a buy order. So you enter instantly in the market and you buy that market. Understand? Then we're talking about sell orders. When we're talking about sell orders, we're talking about when you're looking at your chart and you're anticipating that the market is going to move in the downward direction, and you find an opportunity at that point to sell the market. So you execute a sell order because you're anticipating that the market is going to move in a downward direction. So those are your basic market orders, or your instant executions. Let's move right along and talk about stop orders. Basically, we're going to start talk about the buy stop order. The buy stop order is basically an a pending order. So let's say you're looking at a situation where you like, okay, when the market hits a certain direction, it's going to continue in an upward direction. So in this case, you're thinking that you want to buy the market, but you do not want to buy the market now. You want to buy it at a later stage. Maybe you're not going to be there at that time. You're not going to have time to look at your chart at that time. So you're like, okay, let me just execute a buy stop order. So you set an area in your chart where you think the price is going to reach, and you execute a buy stop order. So the market is going to move up. Once it hits your buy stop order, it's going to trigger a buy trade. So in that case, in that case, a buy trade is going to be triggered, and the market should move in your direction. The market could move in a different direction, but yeah, that's just the way Forex trading works. When we're talking about sell stop orders, though, we're talking about a different thing. In fact, we're talking about the opposite of the buy stop order. So in this case, you're looking at an area in the market, and you're like, okay, when the market hits this area, it's going to continue downwards. Let's say the market has been going downwards, but you think it's going to continue downwards when it hits a certain area. So what do? You execute a sell stop, and when the market reaches your area, it continues in your direction. So that's the pending order when you're talking about sell stops and buy stops. Now let's talk about limit orders. What's a limit order? Limit order is also a pending order, right? So what you're looking for in this case is a reversal. So you're thinking that the market is going to move down. Let's talk about a case of a buy limit. The market, you're thinking, okay, now the market is moving in a downward direction, but when it hits the area marked with an X here, you're thinking that it's going to bounce back and move in an upward direction. So what do you do in that case? You execute a buy limit. With a sell limit, the market will move in an upward direction, and you think when it hits a certain area, it's going to bounce back and move in a downward direction. So what do you do in this case? You execute a sell limit, because this is the limit, this is the area where you feel that the price will exhaust and move in a downward direction. So also in this case, when you know you're not going to be in the market, or you know that you won't have time to look at your chart, or you're afraid that you might miss that opportunity, what you do, you just execute a pending order, or sell limit, or buy limit. Whatever type of pending order you want to execute, you just execute that type of order, and you leave it be. And when the market hits that certain area while you're not in the chart, that order will be automatically executed. Okay, let's look at a basic summary of this course. The summary here is, we're looking at the class of orders, the order types, and the anticipation here. So basically the market orders, when you're talking about market orders, you'll know that you're talking about instant execution. So if you're looking at this section, this green thing, it just tells you that this is an instant execution, so it's an instant buy. And market orders, we know that it's an instant sell. Yeah, that's basically it.